What's up, guys? Welcome to another Market Radar podcast. Hope you've had a great week. I know if you're a bull, you've definitely had a great week after being on suicide watch for the past 2 weeks. We had a great close Thursday and Friday, finally making up for the slow bleed. Nothing too crazy. It's really hasn't been much, honestly, but sideways action mostly. So it's nice getting out of that at the end of the week here. Let's take a look at the schedule for next week. We've got Powell speaking Tuesday and Wednesday. Those are going to be the main days you want to look for. Other than that, we actually have the employment situation, on Friday. So Tuesday, Wednesday, Friday, those are going to be fairly volatile days, especially Tuesday, Wednesday when Powell is speaking. Let's take a look at what happened this past week. As you can see, massive rally on Friday and a great turnaround on Thursday. And this is something that we spoke about in our podcast last week when the sell-off was starting out, that things just weren't lining up. So I'm just going to reiterate what they were. HYG wasn't breaking down with the market. It was failing to break down, which is typically a leading indicator. Same with the Russell failing to break down, crypto failing to break down. I mean, it broke down now, but at the time it was failing to break down. The VIX wasn't rising, and our system was signaling accelerated growth. So things just weren't adding up, and finally we had a snap. And a lot of people are blaming, a lot of the bears are coping and blaming Bostic for this snap up, but he had nothing to do with this. He had absolutely nothing to do with this. You don't know what you're talking about if you think this was Bostic. It was credit markets. Credit markets were moving well before Bostic was even on the radar, and the move started happening well after he already. It was old information, essentially. You think the market didn't price that in, and then he comes out and talks, and all of a sudden the market's like, oh crap, I forgot he said this earlier. We're gonna rip 400 basis points. That's not how it works.
Yeah, no, definitely not. Yeah, that's the old, or I guess it's the copium for the bears, and we're calling it the Bostic bamboozle, okay? Because that's what it is. It's a
Yeah.
bunch of bullshit.
Yeah.
Um,
It was all credit markets, and
yep.
something snapped. We don't know exactly what snapped, but something snapped, and I don't know if do you have anything to add to that? You have any details on that?
Yeah, so let's go over that real quick. I know that I put a thread out on Twitter, but I figured um, some of you may not have seen it or are not active on Twitter. So let's go over what happened. So on Wednesday, February 1st, this was the FOMC day at the beginning of the month. And credit spread, this is the high yield options adjusted spread. And what this is measuring the spread of high yield junk bonds against treasuries. So the wider this spread goes, the more fear there is in the credit markets. The more narrow or the lower the spread goes in number terms is the less fear there is in credit markets, meaning the more risk on it is. Okay. So in a risk off environment, what ends up happening is people will sell high yield bonds at a faster rate than treasuries, and that's going to widen the spread. Meanwhile, in a risk on period, what they're going to do is they're going to buy high yield bonds at a faster rate than treasuries, and it's going to tighten the spread. So what ended up happening here was on FOMC day, shortly or the day following, we had a huge plunge in high yield spreads. And what that was showing you was that there was some really nice demand for junk bonds. Now, shortly after, though, we actually started reversing. And if you notice, the spread bottomed on the 2nd and peaked on the 21st. And this is not a normal move in the high yield market, because you have to realize where we've gone. We went from pretty much call it 6 to 8 month cycle lows right here in the high yield market to above where we were in January, at least in the back end of January. So we were going all the way back up to like early January numbers. We literally reversed a month of decline in the high yield market in a matter of 20 days. So we just did a huge reversal. And what that did was it shocked the markets a little bit. Some, obviously the markets are going to see this and say, whoa, 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 everyone's selling high yield bonds. Or they're not everyone, but they're starting to put some pressure on high yield credit. And why are they doing that? What does the market know? Obviously, the market got spooked. And just because it peaked on the 21st and started going down doesn't mean like the market understood that we were in the all clear, because we have these events in credit markets where we peak, come down, and then we just rip higher. So it took a couple of sessions of lower trading for the market to really absorb what went down here, and for it to start writing off that this was a non-event and this was more of a micro credit crunch than anything else. And that's really what, from everything that I can gather on what really happened here, because you'll notice that the high in the markets, right? So the low on, let's overlay NQ on this. Let's make this white so we can take a quick look. So let's look here. You'll notice that the high on NQ was literally made on the low of high yield. Now, you'll notice this as well, that volatility in NQ on a closing basis slowed down greatly after the peak. You can see here that this was whipsawing back and forth as credit markets started accelerating. The market got really nervous on what was going on, but it wasn't nervous to the point that we saw an actual VIX pickup or explosion or blowout. It's just something that the markets, you could just tell by the way price was going, it wasn't going anywhere. It was making lower highs on a closing basis, and it started falling apart. Now, once high yield peaked, what you noticed here is that the market almost like started basing. Like we couldn't sell down enough to make it substantial. We would always revert. It was like this choppy. It almost felt like a slow bleed to death, but it could never actually go down. And during this whole period last week, in the last week, we were noting that there are certain things that, like the IWM, the Bitcoin, the HYG on a dividend adjusted basis, or in terms of like if you're talking about high yield risk, it wasn't really accelerating to the downside to lead the market lower, and that's what the market was telling us, because it wasn't able to break lower. And then obviously on Friday, we had a nice move higher, which isn't displayed here because this is via TradingView. This data is 1 day delayed, so next day this should print up. Obviously, NQ's higher, and you would almost bet your bottom dollar that high yield has broken lower even further.
So this is what it was, not Bostic.
Yeah, no.
Anyone saying it was Bostic has got the old Bostic bamboozle.
Yeah, because and let's just take a look at Bostic's basically, what Bostic said was that he was favoring 25 basis point rate hikes, and was looking for a lower terminal than what's being priced in. Now, let me show you something. If we look at the expected terminal, this is a rough calculation. Obviously, we're pulling this up on TradingView on the fly. So Bostic started really chirping on Wednesday. Regardless, like you can see that the expected term did not change at all.
Yeah,
literally,
he didn't make a dent in anything.
He didn't do anything. But since February 1st, the terminals have gone up, and this added some extra pressure to equities as well. Like an explosion like this in terminals, things got to get repriced real quickly. And we saw that happen, but it wasn't anything dramatic. Obviously, the market seems to have gotten over that hump. And that brings me back into ES. So as you can see here, ES had some trouble here holding Momo. It did get a little hairy down here, right? But we stayed true to the system and to the signals within the model. We stuck to our guns, and now we're back into more call it acceptable territory.
Right. And we're actually now in a great territory, because everyone that shorted since February 22nd is now underwater.
That's true. And if we go to, I believe, Russell, it's a bit different. Yeah. Russell, it's it's NASDAQ. Sorry. NASDAQ is everyone since the 21st. Any late short since the 21st is now underwater.
Right. So a squeeze could very easily continue.
Right. Now, this brings up the next part that I want to go over in this podcast, which it's the term we've coined called the TOLS, the trade of lost souls. Now, This theory emphasizes the effects on perma bears from impossible. So remember that it's impossible soft landing. Now, we obviously don't believe in a soft landing, but it's we think it's going to occur in a way that people will believe it, and it will gain some traction, and people will sort of discredit the hard landing. That not even that a hard landing will come in the future, that a hard landing will never happen, saying like, okay, this recession avoided type of mentality. Now, this is summed up in our constant mantra that we've been using, saying the soft landing will continue until all faith in the hard landing is lost. And what that basically means is we will continue this emphasis or this market direction of pricing in this soft landing of a recession basically avoided. And once that's being priced in at a maximum, you're going to get the actual hard landing, because it's usually then that you're going to have the entire consensus is going to be lined up to say, you know what, man, maybe a recession isn't possible. And you're going to have everyone geared up for, call it a new bull market. Obviously, we don't think it's a bull market. We think it's a certain regime, and that's
And I
very
mean,
different.
we could get a 10 to 20% move from here in the NASDAQ for sure, maybe even 30% before that happens. We don't know when it'll happen, but as it
Right.
comes closer, our system's going to let us know. And
Exactly.
something for sure is all the perma bears right now are not going to have a good time.
And that's where the term lost souls comes from, because in a risk on environment, you typically have a falling dollar or a very underperforming dollar. And with that will come a rising euro and rising US based equities and choppy bond action. So again, it's called lost souls because most people cannot see any of this happening. They can't believe the dollar can go down, right? If we look at the dollar right here, they just remember this is not what the actual chart looks like. They don't see any of this. This is what a person sees when they look at the dollar. They see the dip and they say, "Oh yeah, dollar's going to go back up. Dollar has to go back up." Why? Because people are very short-sighted. They look at the dollar going back like this, and they say the dollar has been going up for so long. This is a dip. The dollar should continue to go up because of
Because
all
of
this other
inflation. Inflation is still
inflation.
high.
Mm-hmm.
The dollar ripped because of high inflation.
Fed is
Therefore,
gonna have to do more, right? Like that.
therefore,
Yeah.
it's going to continue. But that's linear thinking. We're not linear
Right.
thinkers here. If you're a
Nope.
subscriber, we're smarter than that. That's how we've been ahead of the game for the past year.
Right. Exactly. So let's focus on what the dollar's been telling us. The dollar's been bearish trend since November 2022. So obviously we have we have said this over and over again. Bearish trends tend to lead to lower prices. Bullish trends tend to lead to higher prices. Ride the trends. It's not that complicated. We are in a counter trend move right now on the dollar off the lows. Counter trend is it's obviously up in a bearish trend. That's counter trend. Down in a bullish trend is counter trend. Okay, so this is counter trend right now. Now, what ends up happening is if the trend remains bearish, dollar should go lower. Now we have a whole podcast explaining the situation with the dollar, why we think it should go lower. But long story short, as the ECB rate hike expectations accelerate and build, it's going to continue to generate dollar headwinds. The dollar didn't have these headwinds when we were back here in Q4 of 2022. Now, this is not me also saying that the dollar is going to go down to the lows. It's going to shit the bed completely. This is me telling you that if you have a thesis that's dollar bullish, which pretty much almost all bears have right now, all market bears, well, you have to understand that the dollar is lower than where it was in quarter four of 2022. The terminal is higher though. So the Fed's going to do more and the dollar can't get up. Why? You have to ask yourself these questions. Okay. Why is the dollar not up more, or I should say, not up significantly more than where it was in October? The terminals are up at least, I believe, 30 basis points higher than where they were in October. So why is the dollar still, what are we at here? I mean, we're going to do some rough calculations here. Why are we still 8% off the high or 9% off the dollar highs? Something's not adding up. Most likely, like I've been saying, it's the tailwinds that are no longer there in the dollar. It's going to be harder and harder for the dollar to really put in those cycle or the cyclical highs that you were seeing this whole all of 2022, constant new highs in an environment where the rest of the world is now acting against inflation, meaning the rest of the world is getting tighter and they're closing the gap between the Fed being the most hawkish or the only. So you had the Fed being the only hawkish person on the block. Now they are still the most hawkish, but they are no longer the only hawkish person.
Right. So you have
And
all of these other currencies strengthening against the dollar.
exactly. And let's just take a step back. We can look. We can acknowledge. Obviously, we can see here the dollar is obviously not as strong as it was last year. Something has changed. We already know, we've known this since November. I've said this a bunch of times. Dollar's bearish trend. Bearish trends tend to lead to lower prices. It's really that. You can go that surface level with this. But let's go to bonds, right? So long bonds. These are T-bond futures. Let's go back to that same mentality. The terminal is higher today, the expected terminal, than where it was in October. Yet bonds are we'll do some quick math here. Bonds are 6% off their lows. Why? And it comes back to in October, even though the terminal is higher now, the idea in October was we didn't know where that terminal was going to stop, and it just kept rising, and there was this risk that the market almost absorbed this idea that the Fed may have to go to 10%. Or that's a really like a round number, right? But the Fed would have to chase inflation into the heavens.
Yeah, there was just that
And
uncertainty back then where bonds just didn't know how far this was going to go. They didn't know how high inflation was going to get, and there was just too much uncertainty in the air. Now
exactly.
we're in a position where we've seen a top in inflation. We have pulled back. So there's still uncertainty, but not as much. And that's why you're not seeing bonds trading where they were.
Right. And we can even let's break this down back to even equities, right? Equities bottomed in October when we saw that call it market fear of runaway inflation, right? That's what that was. Bonds were at their lows, markets at their lows. The idea of that inflation wasn't going to be able to be controlled that easily. Well, terminals are now higher than where they were in October. Yet the market, we'll do some more quick math here. The market is 17%, or the NASDAQ is 17% off their lows. Well, most people believe, well, a higher terminal, the more the terminal goes up, the worse it is for stocks. And what the stock market is showing you right now, for the time being, and given the current regime we're in, is that the market is resilient to higher rates, more than at least what people can possibly believe at this point in time, where everyone is so bearish right now because they think that because the market's hiking interest rates, the Fed's hiking interest rates, excuse me, the market's going to have to just have more and more pain, meaning the conditions right now are worse than they were in October. When in reality, the reason the market traded the way it did in October was the conditions were actually much worse from a market pricing perspective because they didn't actually know if inflation has truly peaked. In terms of what we know right now, or in terms of inflation with what we know right now, there's a high probability that the peak of at least headline inflation is in on a year-over-year basis for the time being.
Right.
Talking about
Especially
nine.
with the base effects working against the year over
Yes.
year figures. And
Right.
so the thing that all these bears are getting wrong right now is the NASDAQ is still 25% off its highs.
Oh yeah, that's another
Right?
magic
So
trick. That's a magic trick in itself. Yeah, like let's
think
see.
of the perspective there. You're bearish.
Yeah.
You're thinking, oh, the market's going to collapse. Oh, rates rising, all of this, all these bearish reasons, which, they are valid bearish reasons. That's why the NASDAQ is still down 25%. That doesn't mean
Yeah.
it has to go down another 25% from here. It's not that bad. It's down 25% bad. not down 50% bad. And like you said, we are in a better situation than we were back in October. There's more certainty.
Right. And what's crazy about all this is you have to pay attention to this. So we had a great conversation in the last week or in the last week and a half in the think tank, which is our members only portion of the Discord. And we go back in there all the time between us and the members. I'm always answering questions. Obviously, members have priority and whatnot, but they ask some really good questions, and I try and give them the best answers I can give them. But the one question that stood out the past week, I don't remember who asked it, but they said, "Is it always like this in market pivot points?" And I think that it's a great way to. It's a great question because yes, it is. And if we were to go back in time, let's back to when COVID happened, this was such a dramatic period in markets. I mean, you're talking vol events and whatnot. But let's put the actual crash aside, and you can say whatever you want. Oh, the recovery, the Fed, whatever. The Federal Reserve was literally printing. In this whole period, in this whole operation, we printed 20% of the supply of dollars, and the Federal Reserve unloaded like mega QE. Okay, and there was still bearish people in the market. There was still perma bears. They could you could now look back and say, oh, the Fed was printing. It was so easy, right? Just buy the market. It's never that easy.
No.
When you're knee deep in the
drop like that.
Yeah, when you're knee deep in the shit like that, nothing is clear. I promise you, nothing is clear. And you go back then, the perma bears rode the wave all the way up, pretty much. I know that they started getting they started falling apart like up here, but I know I saw it. I saw it firsthand every day. Recession, unemployment rate, but the jobless claims weren't fading fast enough. There was a million different reasons why the market couldn't go up, and it did exactly that, went up. And just imagine in 2008, if we go back to 2008, after this whole fucking shebang, right? How hard would it have been for you to long equities after this? When complete distrust in the financial system occurred, you would have been scared shitless. Okay, I can tell you when Lehman Brothers went out and you saw all this stuff go down on TV and literally people crying, people losing everything, and you're going to sit there and say, you know what, boys, it's a bull market somewhere, and you're going to just long something. It doesn't work. It's not that simple. Okay, and just like where we are right now, the reason that question is so powerful is because obviously we are very confident with what we do. We've done a lot of work. We've put a lot of time into cultivating our system and our models, but nobody, no fund, no person is going to be right 100% of the time. So there is there's always that bit of like uncertainty that is this really the pivot? And that question that you will have at every turning point in the markets. When the markets went down up here, was this really the pivot? Or when markets rebounded out of COVID, like we just said, is that really the pivot? You won't know until by the time you know that it was the pivot, the trade's already in progress. That's right. The problem. Yeah. You have to be willing to say, you know what? The arrows are lining up. I take my shots. And if your arrows line up right at the right points of time, enough times throughout history, your compounding abilities are ridiculous, and the times that you do get wrong, because no one's right 100% of the time, will be minuscule in the long long game. And it's very important that you pay attention. You watch. So there's a difference between watching the stock market and watching the market, right? And I use the same term in different connotations for this reason, right? Watching the stock market is what your grandpa does in the morning. He gets on the computer and he's like, oh, the Dow's up 100 points. Like, yeah, okay, whatever, right? That's watching the stock market. I check it every day. Watching the market is taking every piece of data you can in a simplified process and looking at it simply and efficiently. Not sitting there. I mean, I've had people send me messages saying that they go through they spend 4 hours a day going through the market. That is ridiculous. That's ridiculous. You're not actually going anywhere with that. What you're doing is it's death by a million paper cuts. Like, you're not actually getting ahead. And what you want to do is you want to look at everything as efficiently and quickly as possible, spot the discrepancies, maybe research those discrepancies, those areas, but going over every single stock and it's like going to the Wall Street Journal page. Imagine you open the stock section where every stock's listed in the S&P 500 and you go line by line. Like, there's no point in that. And you're not going to get anything out of it. So when you watch the market, do it efficiently and understand what's going on and pay attention and just execute. We don't get paid to watch. We get paid to pull the trigger. So if you're going to sit here and watch, and I'm not saying you obviously can do whatever you want to do, but if you become a professional watcher, you're never going to make any money. At some point, executions have to be made, and you just have to make sure that you're aligning yourself up with the highest odds of success over the long term, and you diligently execute as the triggers appear. And when they don't work, wipe your hands down and go to the next one. And I said this today on Twitter. The best winners that exist in the world in all facets of life are the best losers. You have to learn how to take an L and keep moving. And over time, if you know what you're doing, you will prevail. All right, guys, thank you so much for listening. That's going to be the podcast this week. Giga Chads Unite. We'll see you in the chat.